Thank you for joining our program this evening. My name is Erika Roberts, a co-host of this program, in case you're watching it for the first time. And I have my other co-host, Dr. Edward Isuman. Hi, Dr. Eddie.
Hi. Sorry, my name is Erika Roberts and I'm the host of the program. Okay.
Hi, Dr. Eddie.
Hi.
I want to say on air, thank you so much for
Thank
keeping
you.
track of the donations that came on for Janelle's
You're welcome.
surgery. And just a big thank you to all of you who donated towards Janelle's procedure. I believe at least 50% of the contribution came from individuals within the community, not necessarily within our congregation. Is that correct?
Yeah, it's correct. So, we had a broader outreach, and I think it was nice that a lot of people, and even that day, a lot of people were watching, and they were not necessarily from the church. So, the donation definitely would come from all angles, and we are happy and we thank all of them.
Yes. And a lot of you also reached out to your coworkers or family members. And as Dr. Eddie said, a big thank you to you. I know that it was a lot of tremendous effort on your part. And we thank God for touching your hearts for you to be a blessing to Janelle. So we ask God to richly bless you and provide you with all your needs and replenish what you have given to the family. As we speak, there's travel arrangements that are being made by Dr. Yao to proceed with scheduling Janelle's surgery in India. And none of it would have been possible, honestly, without all of your contributions. So we should have additional information next week. Hopefully by then we should know when she'll be having her surgery, and also pray that she have a successful surgery and successful outcome. So before we get started, as usual, we'd like to thank our previous guest. We had two last time, Drs. Nana Ache Yao and Dr. Annette Ansong, for shedding light on congenital heart defects in Ghana, some of the challenges they've been facing, such as lack of equipment in diagnosing and treating these babies, and how we can support as a society. We thank God for them and for all the work that they're doing, especially for Dr. Yao, who is the only pediatric cardiologist in the country. And we thank you to Janelle's family as well for allowing us to highlight her case and share her story. And I hope that we were helpful to them as well. And again, we will let you all know once the surgery has been scheduled. We actually met Janelle on Sunday. Cute, very adorable baby. She was sleeping, but still adorable. We had a conference call with the parents and her aunt, Irabina, as well as the two doctors to kind of coordinate her upcoming surgery. So any news that we receive, we will share in the upcoming program. So now we can get started with today's program on how we can protect our wealth. As I mentioned some months ago, that you and your health programs are tailored around the 9 dimensions of health, and financial health is a huge component of that. One's financial status truly can affect their overall well-being. For your financial status could induce stress, and stress could turn into illnesses along with depression and so on and so forth. So planning ahead financially will not only help you to maintain the lifestyle that you want to live, but it will decrease your stress level and promote a healthy lifestyle all around. So luckily we have one of the experts in the area, Mr. Jimo Hilton, to talk to us about how we can improve on our financial health by protecting our current assets. This is the second series that we've had on financial health. He was actually here this year, March. If I recall correctly, I think it was March 30th. So if you haven't watched that segment, I highly recommend that you do so. He touched on the different phases of life, someone who just started out in the workforce, someone who's in mid-career, and those who are perhaps ready for retirement, on how they can save and also let their money work for them. So a little bit about Mr. Hilton before we get started. Mr. Jimo Hilton is a financial advisor with Blue Mountain Financial Group. He's a graduate of Old Dominion University in Virginia with a Bachelor of Science in Business Administration with a focus in finance. He ventured into his career 2009, where he entered the banking sector and financial services industry, and has worked with several prominent financial firms and institutions in the area. He has over a decade of industry experience, specializing in wealth preservation strategies, business continuation, key employee planning, and retirement design. Mr. Hilton's goal is to assist families, individuals, and small business owners in achieving a higher level of financial independence and security through holistic and comprehensive solutions. Throughout his career, he has demonstrated the skills, knowledge, and experience required to help his clients meet their unique needs and goals. So let us welcome back Mr. Jamal Hilton.
Hello, thank you.
Thank you for accepting our invitation for you to come back. We certainly appreciate it. And I think the last segment was very successful. I know a few people that actually did ask for you to come back. So we're grateful that you accepted Dr. Eddie and I's invitation to come back to our program.
Well, thank you
So
for the warm introduction and thank you for having me back. I think that's a good sign for your ex to come back. So I appreciate that as well.
So to our audience who are watching, this is a question and answer kind of segment. So please feel free to post your questions and Dr. Eddie would project them. So I don't want to be the only one asking questions here. So if you have any questions at all, nothing is a bad question, to be honest with you. So any question that comes to mind, feel free to post it and he can give you his feedback about that. So I was just wondering, for those of our viewers who perhaps was not able to watch the last segment, whether you be able to recap our discussion in terms of how folks can build on wealth, especially new graduates, because we do have a lot of college graduates within our congregation, as well as mid-career individuals as well.
Absolutely, certainly. I could definitely paraphrase some of the things that we talked about the last time. And some of the things that we talked about last time, we will actually touch on as well this call, and we will expand on it a little bit. So the last time we spoke, we talked about the pyramid of finance and what financial planning involves and what you can do at different points in your careers. One of the major things you could do, and if you're thinking of the image of a pyramid, right? The pyramid has a broad base and it gets narrow at the top. So if you're considering yourself a financial pyramid, at the base or the foundation or the core bottom of that pyramid is protection, right? And so you want to make sure that you have your protections in place. And then the level above that is what you would consider growth. You want to make sure that you're able to grow your assets. And then at the top of the pyramid is distribution. You want to make sure that you're distributing your assets in the most efficient way. And like all things, there's a right way to do things and there's a wrong way to do things. But if you do all three of those things the right way, more than likely you're going to have a higher success rate when it comes to your finances. And the first level, the protection part, you should make sure that you have in place, whether it be, early retirement or when you're first beginning. But the best time to take care of that part is when you're first starting out. Unfortunately, some people haven't, so that's when they have to do it later on. But that's something you want to start out with first.
Okay. Thank you for that. So, in the news, I'm sure everyone has heard the word inflation has been spoken about a lot. We've noticed that housing prices have gone up,
Mhm.
groceries have gone up. So, if you don't mind just explaining what exactly inflation is and how we can protect ourselves and our assets from inflation.
Yeah, so great question. So you're absolutely right about that. I mean, gas has gone up. The cost of energy in general has gone up, and that happens from time to time where you have periods of low inflation and you have periods of high inflation. That being said, inflation is actually built in the system. Main reason is because the U.S. economy, or what they call GDP, gross domestic product, is largely based on consumption. Okay, when people go out and buy goods and services, that's what really drives our economy. And so the policies that's made in this country is largely made by monetary policy, which is the Federal Reserve. And the Federal Reserve is involved in printing money, as they say. And when there's more monies in the economy, that drives down the value of each dollar. And so it costs more to purchase items. So an example of that is a brand new Corvette Stingray in 1960 was about $5,500.
Mm.
Okay. Now, if you took that $5,500 and put it in your mattress and say, you know what, this year I'm going to take that money and buy a brand new Corvette, more than likely you wouldn't even be able to get the tires because inflation has eaten away that purchasing power. So the key thing to deal with inflation is make sure that your money is growing at least at the pace of inflation. So inflation has historically grown around 3%. Right now, maybe at 2.5%, creeping up to 3%. So if you have, for example, all of your savings in a bank account or money market or CD or just regular savings, and it's earning 0.5%, you may think, you know what, that's a safe place. Nothing could happen to it. But unfortunately, it's not safe at all. It's actually being depleted every year by inflation. And let's say inflation is 3% and your money is earning 0.5%, every year you're actually losing 2.5% on your money. And you may not feel that in the first year, but it actually adds up when you try to use that money to buy a Corvette.
So I have a couple of questions about IRAs,
Okay.
particularly for those who have recently graduated and have their job and their first job or major job, and also those who may be considering starting an IRA for their children. So when for a child, when would you consider starting an IRA? Was an IRA a good idea to begin with?
Absolutely. So you could contribute to an IRA whenever you have income. So, like most kids, they started working in high school. At least I did. You may have as well, where you got your first job in high school, got a
Mhm.
paycheck. You was able to save some and spend some with friends.
First
Um,
job at 14.
14. Okay, it was 15 for me with the workers permit.
A
So
clothing store in Greenbelt.
So at that point, you could actually start contributing to an IRA. Now you have different types of IRAs. You have regular IRAs or what they call traditional IRAs, where you put the money in on a tax deferred basis. You don't have to pay the taxes now, but you pay the taxes later distribution. And then you also have what's called a Roth IRA. That Roth IRA that actually works the opposite way, where you put the money in after tax, so essentially money that's already in your bank account, and that money then grows tax deferred. But if you take it after a certain time period in retirement, you could actually take that out tax free. So that's one of the few vehicles that you could actually get tax free growth in your account. That being said, if you have a child, you could set them up with one of those accounts, a Roth IRA or a traditional IRA, have them put a portion of their savings from earning money, and that money will continue to grow either tax deferred or tax free. Now, one thing about savings or growing assets is that you have different phases of growth. And the last phase of growth is what we call the rocket phase. That's where you have money compounding on money that has previously compounded. And so if you look at a savings growth rate, and you add compounding to that graph, you will see that the line kind of works up and it grows exponentially. And the reason why that happens is because the previous monies that has compounded over and over again. And the best way to make it to that rocket stage of growth is by starting early, because then the money actually has the time to compound. And so setting up a IRA account for a child is the best way to have that money grow really large over time. And as long as they have income, they could contribute to a Roth IRA. A matter of fact, if you pay them to complete chores around the house and stuff like that, they could use that to contribute to an IRA as well.
Okay, let's see,
So
Dr. Eddie. So,
I have a question on inflation. That is why I came in so that we don't go and then leave my question. So do we have anything like transitory inflation, or can
Yes,
we say that the inflation we have now is more of an artificial one than
yeah,
the
so
permanent?
that's the hot topic, right? So Jerome Powell, who's the head of the Federal Reserve, has been saying no, inflation is just transitory. It's not here to stay. It's one because economy was locked down, nothing was moving, and then it all of a sudden opened back up, and so you have this pent up interest. You have shipping that was disrupted, all these things that was disrupted, and so it has to play itself through. Um, Now, who has a crystal ball to say if that's true or not? And there's two sides of the aisle that says, this is here to say, and this is something that's going to be temporary. With that being said, if you look at some of the what we call macro factors, we had a lot of spending that took place for pandemic COVID relief, trillions of dollars. And then now there's potentially additional billions of dollars that's maybe even trillions that's coming into the system through infrastructure. So all of these factors can contribute to higher inflation in the future.
Okay, so to me, the layman, a
Yes.
person who doesn't know anything about business, is it assuring, or do we see any progress that inflation is going to be curtailed or would go down so that I can use my $2 to buy my bread?
Yes. So
And
so
what are
one
the
thing.
time frame we are looking at?
Yeah. So one thing, inflation will always be in the system. It's literally wired and built that way. So you may have times where we had low inflation, where it's sub 2% for a long time, and then we have times where the inflation goes higher. But whether it's a little low or higher, 2%, 3%, or 5 and 6 and going up, it's a part of the system. So the main thing that you could do as the layman, so to speak, or the individual, is make sure that your money is growing at least at the pace of inflation. So, you have your $2 for your bread, but put a dollar away, and it's something that's gonna, grow. So that way, if years down the line bread is $3, you'll have enough to purchase it. If that makes sense.
Okay, so do you recommend that workers or laymen ask for more money from our employers?
That's a great question. So yes, so you should actually, there should be cost of living increases when the inflation comes in and goods and service and housing and everything around you increases in cost, then your pay should be increasing at that same rate as well. Unfortunately, that has not happened.
That is not
Um,
happening at all.
that's not happening. But as an individual, yes, you should definitely, when it's time for your annual review or what have you, definitely present the strong case for you to get an increase. And, at least so that way you're keeping pace with inflation. Because as rightly noted, if inflation is happening and you're not getting any more money, you're actually making less money.
So okay, so Erika,
yes,
pardon me,
go ahead.
okay.
No, 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 go ahead.
So okay, so now we ask for more money as laymen, we ask for more money, or the people ask for more money, and then when there's still less supply, because I think what we are experiencing now is more of a supply and demand issue, right? So then if we are getting more money and there's still a shortage of what is it, supplies and commodities, then definitely inflation is going to quadruple.
Yeah, so you're not necessarily going to come out ahead in that situation, right? You're more or less going to keep pace, but you want to
Okay,
at least keep pace. I mean, that's the best. If that's the best, solution, then keep pace is better than going backwards.
going backwards. Okay. Thank you. Real quick.
No
You
problem.
can
All
continue with the
right.
IRA, and I'll come
I
up
know.
with
I'm so
some of the
curious. I have
questions.
another one because someone asked me this question before, so I want to know.
Okay.
So those who have an IRA, I know that you can take it out at the age of 59, right? If you take
59
it
and a
out
half to be
59
precise.
and a half, okay. So if you take it out before that, you do get penalized for it.
Yes, you have to pay a 10% penalties minus certain situations that the IRS has rules for that allows you to take it out without penalty, but there's a very short list of reasons to do so.
Okay. So I guess my question is, and then we'll answer this question below. So my question is, are you able to keep it in long term? Like if someone doesn't want to touch the IRA at 70 or 75, is that okay? Would they get penalized if they keep it there
That's
too long?
that's a great question. So the traditional IRA, and that's the IRA that grows tax deferred. So you haven't paid taxes on it. It's growing tax deferred, and you're going to pay taxes when you take distribution. A traditional IRA allows you to take money out at 59 and a half, but it requires you to take money out at age 72, whether you want to or not. This is something that a lot of people aren't aware of. And they're like, I don't need this money. I don't want this money. But Uncle Sam is like, you're going to take it out anyway because we want to get our tax dollars in your lifetime. So a traditional IRA does have a minimum distribution that you have to take at a certain point. And at this point, it's 72. It was previously 70, and it was moved up 2 years with the CARES Act. Now, as far as a Roth IRA, one of the beauties of a Roth IRA is that you do not have an age where you're required to take that money. That money could actually grow indefinitely, and you could pass it down to a beneficiary or spouse or heir, tax free to them as well. And that money, does not have to happen or does not have to be distributed by a certain point. So
Okay.
the traditional IRA, you are required to take distribution at a certain point, and a Roth IRA, you are not. And I think we have a question.
Yes. So that's from Auntie Jane. For a young person, is there a minimum amount to deposit yearly into an IRA?
Great question. So the maximum that you could put into an IRA in any year is 6,000, unless you're over the age of 50. Then you could contribute an additional 1,000. So if you're thinking of it monthly, you're talking $500 a month for somebody under 50. But there is no minimum to put into an IRA. So if you want to start an IRA with $100, you could start an IRA with $100.
Okay. Is there a minimum age? Like, do they
Uh,
have to be 18 or could it be under 18 to
you
get an
can
IRA started?
you can be under 18 to get an IRA started.
Okay.
Yeah.
Okay. Dr. Eddie, do we have additional questions before I move on? You probably projected if we do have. Should you keep multiple company 401k or should you roll it up into one?
Yeah. So that's another good question. So it depends on the situation, but for the most part, I will say no, it doesn't necessarily have an advantage to be at multiple places. Um, and just think about it this way: like most people won't leave like their coffee mug or their stapler with their old companies, but for some reason leave their retirement account. But regarding the retirement account, there's advantages of it being in a 401k. And the advantage of it being in a 401k is that you could borrow against it. So when the money is in a 401k, um, you could take a loan against it, repay that loan through your paycheck, and it not be penalized. You'll just have to pay that interest, and part of that interest goes back to yourself. But that's with your current employer because you need to have payroll deduction in order to do that. So you don't get that same benefit from a previous employer. So I would say it probably makes most sense for most people to roll it over into, I would say, an IRA or maybe a portion of it into your current 401k. And the portion to roll into your current 401k could be a portion that you may possibly borrow in the future. So let's say, just to keep it simple terms, if you have five IRAs out there and they're all $25,000 each, then you may roll. Let's say may borrow 25,000 in the future. I may roll 25,000 into my current 401k for the borrowing ability in the future if happen to be needed, but the remaining could go into an IRA that has a lot of other advantages, including more investment options, potentially lower cost, and being able to be a little bit more customized. But
Okay.
great question.
Do we have an additional question, Dr. Eddie? But in the meantime, let me ask you this question about retirement, because that's something I've thought about. Do everyone have to wait? For example, if your retirement age is 67, at 67, 69, or even 65, would you recommend people waiting to that time, or would you advise them to start withdrawing from Social Security at 62? Because I don't think anybody really wants to wait till 65 or later if they could get it early.
Right. So the earliest, as you noted, you could withdraw from Social Security is 62, and the latest you could withdraw from Social Security, or the longest you could defer it, is till age 70.
Okay.
Now, for most folks that's still working, their full retirement age may be 67. And so how do you decide, okay, do I collect it at 62, 67, or 70? It depends on the situation, but typically, if you have uh, family history of parents living a long time, or you have grandparents that lived a long time, and siblings that older siblings that lived a long time, then you may have a long lifespan. And in those cases, it may make sense to defer it because then you'll collect more money over time. So each year you defer it. I believe it's like an 8% growth that you get for deferring it, meaning 8% next year is going to be what you could withdraw more than the previous year. But if you have a family history of people passing early, then it may make sense not to defer it, right? Because you want to collect it while you can. So I would say to that question, it depends on the situation. Now, some folks are going to retire early. They're going to retire as early as they can, and in those cases, you may have to collect Social Security early to make up the difference in income that's needed to live. So, definitely, take advantage of getting that income early. One, if needed, and if family history makes sense for it. But if it's not needed at all, and family history doesn't make sense for it to collect early, then it may be advantageous for you to defer it to get that to get a greater amount later. So it really depends on the situation.
Okay, so we have a question, Lisa. How do you determine how much to save for retirement?
So a good rule of thumb is you want to put away at least 10% of your income, and I'm talking 10 take home income. Now the question is, where do you put it? What's the most efficient place to put it? So oftentimes putting a portion of it into your employer's 401k plan is a really good place to start. One, because a lot of employers offers matches, and they'll match your first 5% or 4% or 6%. And that match that you're getting from the employer is essentially free money. So it's good financial practice to collect free money from an employer when eligible. And so you want to start there, and then from there you can decide, okay, where's the other places to put money for it to grow, not only tax efficiently, but with the ability to compound and things like that. So definitely want to start off with at least saving 10% of your salary. Now, if you're going to retire early, which I have clients that decided, you know what, I'm going to retire as early as 55 or 60, then you may have to put more money away. And that's where I help clients with retirement planning, where I say, okay, let's have a conversation. What does retirement look like for you? We could actually plan it out, and I have the software and everything that could tell us, okay, based on the age you plan on retiring, based on the monies that you are going to use in retirement, you need to put at least this much away. Because if you're going to retire at 55, you're probably going to need to put more away than somebody that's going to retire at 70 because you're going to be using it earlier.
So this is a question from Dana. Sounds comparable to TSP, is it?
Yeah, so great question. So 401ks, TSPs, 457s, 403bs, they all work the same way. They're what's considered defined contribution plans, meaning the amount that you could put into it each year is defined. But they're just different tax IRS code for the same thing. So if you work in government, there's a tax IRA code for that. Private sector tax IRA code for that. Nonprofit tax IRA code for that. So those retirement plans are named after the kind of the tax code, but they all work the same way, and that's putting money away on a tax deferred basis, and having a defined amount that you can put away.
Okay. So the next question is, should you put more than what your employee matches?
Great question. So that also depends. It depends on what type of investment options you have available to you. Depends on what other things you need to take care of in your life because we all have fixed amount of resources. And so whether it's, 100,000 a year, 200,000 a year, 300,000 a year, 500,000 a year, none of us are printing our own money. And so we have a fixed dollar amount that we have each year to take care of all of our goals. And so with those fixed resources, you have to make sure that it's hitting all the appropriate buckets in your life. And so, putting up to a match is definitely a first bucket to start with. But then you also need to take account of what other goals do you need to accomplish, and other buckets you need to put money in. So I would say it depends on the person if it makes more sense to put more than the match in the employer plan. But at minimum, you definitely want to put the match, and then anything above that depends on what other options you have.
So anything above that, for example, if you do not have an IRA, a Roth Ira, and you've already matched your, whether it's 5% or 6%, would you recommend they put some in an
Yeah,
IRA?
great question. So it depends on the situation, but like for example, I'll use myself as an example, right? So I want to make sure that I actually put the match and then excess money that I may be putting in Roth IRAs because I have to have tax free growth of my money. I know taxes are coming later, and the most as much as I can avoid taxes, I will legally. Um, and in other areas like cash value, life insurance, and brokerage investments. So for me, I'm putting up to the match, and then I'm putting my other monies in other areas.
It's talking about taxes. How can we avoid taxes or
Yeah, yeah,
protect our investment from
yeah.
taxes?
So there's very few areas that you could just avoid taxes all out, or all completely avoid it altogether. One of those few areas is college saving plans. They allow you to put money. IRS allows you to put money in certain college saving plans, and if those monies are specifically used for college expenses, then you get to deduct what you put in, and then you also get to use the money tax free. So you didn't pay taxes now, and you didn't pay taxes later if you used it for those purposes. Um, Health saving accounts are the same way. Allows you to put money in tax deferred. If you use those monies for health related expenses, you don't have to pay any taxes on it. So you didn't pay any taxes now, and you didn't pay it later. Now, that being said, there are ways to actually get tax free growth. You'll pay taxes now, so to speak, because the money's already in your bank account and it's already been taxed. But moving forward, it won't be taxed again. One of those things we talked about is the Roth IRA, which is a very powerful tool. That monies that you put into a Roth IRA grows tax favored, and if used in retirement, you could get the money that you put in plus the growth in the account tax free. Very, very powerful. especially against something we can't control, which is taxes. And so, one thing about finances, you want to eliminate as much variables as possible. And if you have money in a vehicle that you know you're going to get that dollar amount out without taxes, that's a very powerful tool versus something where you don't know exactly what you're going to end up with because 30%, 40%, 50% could be taxed, and you have no control over it. Um, Other areas where you could get tax-free growth is one area is in cash value life insurance plans. That's something that's not as known about. And one of the things that you could do with the cash value life insurance plan is the money that you put in, the death benefit goes to your beneficiary tax-free, but you could actually use the cash value that grows into the plan tax-free as well. And that's another very powerful tool that people are that's in the know take advantage of. But unfortunately, I see not enough people know about that to take advantage of it.
So talking about life insurance, what life insurance would you recommend at someone who's at the end of their career, like a whole life insurance or term
Yeah.
or?
Yeah, so you have two main types of life insurance. You have term life insurance, which is essentially temporary life insurance. Term life insurance could cover you for a specific time period. That could be a 10-year time period, 20-year, 30-year, or it could be through your employer and it covers you the time period of the length of your employment. So when you leave your employer, that coverage ends, or the 10-year ends after 10-year, 30-year. Those types of coverages are typically lower cost or no cost if it's through an employer. Oftentimes up to your salary or a couple or two times your salary. Um, or if you get it individually, it's typically low cost because one, it covers you for a specific time period, and for it to pay out, you have to essentially die during that time period. So if you have a 30-year term and you don't convert it to a permanent policy, after the end of that 30-year, the term could essentially expire. And if you pass year 32 and you don't get anything because that term period ends. Now, on the other side, you have permanent life insurance. The most popular type of permanent life insurance is whole life. It actually pays out 100% of the time because we are nobody that we've known personally has defied death, right? So
Yeah.
it's like an inevitable at some point. So at that point it's guaranteed to pay out. And so it may make sense to have at least a portion of your insurance be permanent. That being said, permanent insurance has a higher cost
I was going to ask that
because
question.
it has a cash value component to it, and then in addition to that, it's guaranteed to pay out. So the statistics on this usually blows people's mind, but term insurance usually only pays out 3% of the time because you have to pass during that term period for it to pay out. Versus whole life, if you have it on the books, it pays out 100% of the time. That being said, it actually does in most cases make sense to have both term because of the low cost and the ability to convert it later, and then having a portion of your insurance be permanent, so that way at the end of 30 years you still at least have certain amount of coverage to pay burial or what have you. In the older years where you may actually need it, and the probability of it happening is greater. And then two, along the way, you have growth in tax deferral and all the other benefits that come along with it.
So we have a question from Dana. Is that a flexible health spending account you were referring to? I guess that's previous
Yeah.
conversation. And
Yes. So no. So a health saving account is actually different than a flexible spending account. A flexible spending account works similar to a health saving account, but it doesn't. From my knowledge, it does not roll over. So a flexible spending account, a lot of times at the end of the year, you're like, okay, I need to go to the dentist. I need to maybe get new glasses, or I need to spend this money because it doesn't roll over. Versus a health saving account, that money actually stays deferred, tax deferred, and you could use it now or you could use it in retirement. It doesn't. It's not a use it or lose it type of thing. It just continues to grow. Now, typically, to get access to a health savings account, you have to be in what's called a high deductible health insurance plan. And that's a plan where the monthly premiums might be lower, but your deductible is higher. And so they allow you to set up a health savings account along with your insurance plan. And the idea is the difference in the monthly premium costs from a PPO or another type of health plan, is that you'll take that difference and what you're saving monthly and you'll put it in a health saving account and kind of, grow that health saving account higher and higher, instead of paying that higher monthly premium for like a PPO or another point of service type of health plan. Um, that being said, what makes the most sense, what type of health plan, that's a deep conversation. But for a lot of young people that they may only go to the doctor once a year for their annual checkup, high cost insurance, because they're only going once a year. So, health saving account may make sense for those types of folks. But if you have a lot of health concerns and you're, are having to go to the doctor often, then it may make more sense for you to pay the higher cost to have the lower deductible.
Okay, I think there was a second portion to that question in terms of establishing a nonprofit for tax. That would start a nonprofit also aid in tax deferral?
Yeah. So when you start a nonprofit, that nonprofit in itself, depending on how it's set up, whether it's a 501c or whatever have you, depending on how it's set up, it may have specific tax savings to it. But just starting the nonprofit itself won't necessarily help you in tax savings. The entity itself has tax savings, but you as the individual, it may not necessarily help you. Now, one thing you could do is you could contribute to the nonprofit and have those type of write offs. If that's what you're asking, you could help you in that end. But there are some rules pertaining to that, especially your own nonprofit, and that's something you want to make sure that you have a good conversation with an accountant regarding, because some people have gotten in trouble, not walking a clear line when it comes to their own nonprofits.
Okay, so the next question is, will you rather not max out your contributions at work based on the maximum allowed by the government before looking outside because of a tax
Yeah.
deferral advantage?
So yes, so that's a great question. I would say it depends on one, it depends on how much you actually make, right? So some people, so the max for most 401ks or TSPs or what have you is 19,500. So depending on the amount of money you make, even if you save 20% of your salary, you would not save 19,500 throughout the year. But you have some people that if they save 5% or 10% of their salary, they're maxing out their 401ks or TSPs halfway through the year and they can't contribute anymore. So I would say it really depends on what your actual income level is. Um, so based on your income level, yes, it may make perfect sense to max out your 401k or TSP and then start looking at other options. But other folks may have limited resources. So in that case, it really depends on the situation.
Okay, so this is for my sister. Benji Roberts, what is the maximum I could contribute to my retirement fund per year?
So if you're talking an employer plan, that's 19,500, I believe for 2021. If you're talking for like an individual retirement account, if you're under the age of 50, that's 6,000. If you're over the age of 50, that's 7,000 is the maximum you could contribute. And if you're talking about like a individual plan for business owners, they have their own limits as well. So they have, as a business owner, you have the option of SEP IRA that allows you to contribute 25% up to, I believe it's like 52,000 for the year, or simple. That's, I think it's closer to like 11,000. So it depends on the type of plan, but those are the different limits for most of the plans that's out there.
Okay, so we have a long question for Mrs. Major. So wow, also thinking on these funeral plans. Yes. I've seen commercials. Are they any good? Do you or your company offer family insurance plans? I'm very interested in knowing
Yeah.
more to fit my budget.
Yeah. So a family insurance plan. So the most common type of, I guess, family insurance plan is a survivorship plan, where the life insurance is not just based on one individual, but it's based on two individuals. So typically husband and wife, and it pays out the when the second one passes. And that's usually used most often in estate planning purposes. It's lower cost than an individual, and you're able to leverage your dollar to get more insurance. And That's typically taking care of like maybe taxes that's going to come up in estate planning. And then sometimes you could attach riders to those type of coverages, and those riders could look in the form of like child term rider or child rider to insure a child as well. Um, as far as family, quote unquote, family plan, if that's what you're talking about, that is something that I have access to for clients that need that type of services. Now, as far as what you see on TV, there's a couple different things you see on TV, but I'll answer to the ones that I think I've seen on TV. So, as far as like burial, that's a separate type of insurance. Like if you want specific burial coverage, you could go to a funeral home and say, "I want to be buried at this particular plot, and I want to prepay it." That's an option as well. Or you could get a permanent policy that for 25,000 that will cover for most burials, or 30,000 or what have you, and have that go to your beneficiary to take care of final expenses. Now, that's not going to be tied to a specific plot or funeral home. That's just they're just going to get a check and they could use it, however appropriate. Now, as far as the different types of like burial insurance, or what they call insurance, where you may not necessarily have to answer any questionnaires, or just for this dollar amount, then you could get covered. Typically, those type of insurance are lower dollar amounts. They start as low as 5,000. They could be 10,000, 15,000, 25,000. Some companies may go up to 50,000, but most part they're capped at 25,000, and they're issued on a guaranteed basis, which means typically it's a higher rate, and that's how you price insurance in the guaranteed field, right? So when you have guaranteed insurance, then most people that's going to apply for guaranteed insurance are going to be high risk people, and so it's priced accordingly because you have a high risk pool, and so it's typically higher cost than, let's say, if you go and get a non-guaranteed policy, but you have to go through underwriting, because then that kind of keeps the high risk sort of super high risk people out of that pool. Now that being said, it's actually less difficult to get insurance than people think. A lot of people think you have to be in perfect health to get insurance. That's not the case. I've written life insurance on people with heart conditions. I've written life insurance on people diabetic, high blood pressure, cholesterol, high cholesterol, uh, um, post cancer as well. So you don't have to be in perfect condition. Most likely, what they do want to see is that if you do have a condition, that is controlled either by lifestyle medicine or what have you. But most people are more insurable than they think.
And they have access to like the meds that you take, correct? Or
That is correct. So
okay.
part of the underwriting process for most insurance companies is going to involve a prescription drug search. So they're going to search what prescription drugs you've been prescribed, and they may involve looking at medical records, and it may involve you completing what they call height, weight, blood, and urine.
Okay, so there's another question. I guess it's a follow-up question from the previous one. Does the total amount per year includes my employer's contribution as well as other contribution I made outside my employment?
Great question. So that 19,500 does not include the employer's portion. And it does not include, like, let's say if you have an IRA or something like that, that does not include other, retirement, like IRAs or SEP IRAs or anything like that. But as far as 401ks, you are capped for that
Of
dollar
that
amount.
amount.
Yeah.
Okay. So
And
you
if you
meant,
and if you over contribute to an IRA, they may require you to take money out as well.
if I contributed more than the maximum in a year, would there be a tax penalty?
Yes, so you will be required to take that money back out, and if you don't, you will be penalized. Yes.
Okay. So you have to contribute, but you can't contribute too much.
Mhm.
So you mentioned a little bit about business owners, and I was just curious as to whether everyone that owns a business, whether they should have an umbrella coverage or liability coverage.
Yeah. So as a business owner, you definitely have additional risk being a business owner, but actually, umbrella coverage is something um, that you should not only look at because you're a business owner. Individuals could look at it too. Typically, umbrella coverage. Oh, let me start with what umbrella coverage is. So, coverage is typically coverage that's on top of the liability coverage that you already have. So let's say if you own a home, you have homeowners insurance. Let's say if you rent an apartment, you may have renters insurance. You drive a car, you have auto insurance. Okay, that's liability coverage. And then an umbrella coverage is on top of that, similar like an umbrella, literally, to provide additional protection. Because in your auto policy, you may be capped at 250,000 of coverage. Now, let's say, God forbid, you're in a terrible accident and somebody gets hurt or killed or something, they may sue you for greater than your insurance will cover, and then you may be on the hook for the rest. And so, umbrella coverage protects against catastrophe. It's the very unlikely event that it happens, but unfortunately, it happens to someone, and that unfortunate person that it happens to could, wipe them out financially. And so, it's a way to get a low cost additional coverage to put on top of the coverage you have already to provide you with additional protection. Now, this is something that's not only for business owners. I think this is for something that all individuals could look at, especially if you have assets to protect. Um, a general rule of thumb is you get umbrella coverage that matches your net worth. So if your net worth is $1 million, you get $1 million of coverage. Your net worth is 10 million, you get $10 million of coverage. They typically start at $1 million umbrella coverages, and reason being is it's again on top of the coverage that you already have, and it's just the added protection, and it kicks in when those coverages are maxed. But it's a good
Okay.
question.
So let me ask Dr. Eddie before I ask another question. Dr. Eddie, do you have any more questions? Okay, so if you are in excellent health and close to your retirement, would you still advise your clients to be very conservative when the life expectancy of a very healthy person close to retirement may be in the higher 80s?
Yeah. So I guess I'm not sure exactly the question, but when you say conservative, if you're talking about like designing income in retirement, meaning, how long do we need our monies to last? I typically am conservative in the sense that I try to overshoot. So, for most folks, we'll start at, we want to have this money last you at least till age 100. And so we try to design from that point where, okay, if the money's going to last till 100, how much do you need to make it there with your specific lifestyle? And we could design it to age, 120. We could design it to age, 75 or, what have you. But typically the starting point, we try to make sure money lasts is at least to 100. I'm not 100% sure if that answered your question or not, but if not, then you could clarify your question. I'll try to answer.
So I have a question regarding jointly owned assets. I read that that's one of the ways to try to maintain your wealth. Is that accurate?
So yeah, so in the sense of, I think what you're asking about is creditor protection.
Credit
Okay,
protection, yes.
creditor protection. Now, so there's not a quote unquote single way to make yourself 100% protected against creditors, but different things that you could do puts up more hurdles, and the more hurdles, it makes it more difficult for creditors to have access to your assets. And like all things, most people go after low hanging fruit, and then if the fruit's more difficult to get to, they're less likely to go after it. Now, one of the things that you mentioned is joint account. Well, yes. So, a single account is easier for a creditor to get to than a joint asset. And then, down the line, there's different things you could do to make yourself more creditor protected. But I think in the most practical sense, while most of us may not necessarily face a situation where we're dealing with credit protection, we may deal with the situation of death or something like that. And in that case, having a joint account is actually a good thing because it could avoid probate. It could avoid having to go through the courts, especially for a non-spouse. Like if a person's not married but they have bank accounts different places, it may make sense to have them either add somebody on the account or at least have a POD or TOD on the account, which is POD is payable upon death or TOD is transfer upon death. And that allows that money to go through to a beneficiary without having to go through the courts or probate. Because if you have to go through the probate process, you understand that it's not only timely, but it's costly. And if you can, you want to avoid that as much as possible. So having a joint account, that asset will, be able to pass on without having to go through that probate process.
Okay, so looking at our time here, so I guess one of the biggest question is how can we ensure that our family will be taken care of if something was to happen?
Yeah. So two really big things to do is if that thing that was to happen is a injury or sickness, you want to make sure that your income is protected. Because you don't want the unwanted extra burden of, God forbid, you're sick and you're battling something, and then now you have to deal with, on the top of that, not able to cover the expenses because you're not able to work. So you want to make sure that your income is protected against sickness and injuries. Oftentimes, you're able to get that type of coverage through an employer, through what's called long-term and short-term disability coverage. You want to actually look at that. Unfortunately, I review client benefits through their work all the time, and what they feel that they have, they actually don't have, and unfortunately, they don't realize they don't have it, or what they thought they had is not there until it's too late. And so, what you want to do is actively, proactively, if you have a pen and paper right now, make a note. Actually, go through your employer plan and see how much disability coverage do you have. When does it kick in? How long does it last? Every employer is different when it comes to this. Some employers, their disability will only last 2 years, some 5 years, some 10 years, some till age 70. So you need to know what you actually have. And also, is that sufficient? Is that enough to cover your at least minimum expenses? If not, then you want to get additional coverage in addition to that. So, one, again, protect your income. Another thing is, in the event that you do pass, you want to make sure, unfortunately, if you do pass, you want to make sure that you have life insurance in place. So that way your family could hopefully maintain a similar lifestyle to what they lived before. And that lifestyle could be maintained through, the leverage of life insurance.
You're on mute, Dr. Eddie.
We can't hear
You're
you.
on mute.
There
Okay.
is a question to life insurance, but before that, somebody's asking, is it advisable to take money from your 401k without payment or borrowing?
Yeah. So if you take a withdrawal from your 401k,
Mm.
you're going to have to pay taxes on it. And if you're under the age of 59 and a half, you're going to have to pay penalty on it. So let's say if your tax bracket is 24, you're in the 24% tax bracket. combine that with the penalty, combine that with state tax, you could be talking about 40% of your, 40% of what you're taking going to Uncle Sam just there. So, so would it be advantageous to do that? No, it definitely wouldn't. But let's say you have no other choice. Let's say you have no other savings. You didn't save in a cash value life insurance. You didn't save in a Roth IRA. You don't have other savings in place, and that's the only thing you have. Then you have to do what you have to do. But understand that it will put you in a position where you've just taken a step back, and so now you're going to have to work even harder to get to where you were before to then go forward. So one of the main things we do in finance is we set up your situation so that way you don't take any step back. Even if something happens that's not expected, you have contingencies in place, because the best way to move forward is to not take any steps back. But if you don't have a choice, you don't have a choice. But it's definitely not advantageous to do so. But some people unfortunately don't have any other option.
Okay. And then with the life insurance question, in a whole life insurance plan, when the insured passes, does the beneficiary receive both the death benefit as well as the cash value?
Great question. So the short answer is no. But there's specific types of VULs that you get both the living benefit and the death benefit. But in most time the cases is no. But that being said, the death benefit actually grows by the same pace, if not greater, than the cash value growth. So let's say if you start a policy, let's say if it's 500,000, you started a $500,000 whole life policy. 10 years from now, that death benefit could actually be 600,000. So, and the cash value in it could be 80,000. So the cash value grew by 80,000, but the death benefit grew by 100,000. So your beneficiary gets, the better the situation, they get the growth in the death benefit. So they don't get both, but it's accounted for. A good question.
Okay.
Do you have any more, or?
Yeah, I think it was just a follow-up to the question I asked earlier about the 60, and the person is asking that after all your explanation, is this after age 60?
No, so the penalty only happens before age 60. You're not going to get penalized after 60. You're just going to have to pay the taxes if it's traditional account, but you're not going to have to pay the penalty. But if it's a traditional account, you can't avoid the taxes anyway. So, whether you take the deferral at 60 or 70 or 80, you'll always have to pay those taxes. That being said, you could run the risk of, if you take a big chunk in 1 year, you could run the risk of that pushing you into a higher tax bracket, and then you would have to pay more taxes on that money, which, not a good situation. So you do want to make sure you at least spread it out so much that you won't, the withdrawal won't cause you to go into a higher tax bracket.
All right.
But
okay, thanks.
So probably my final question is, what is the most important thing that one can do to protect their assets, protect their finance?
yeah, so I'm not gonna say one thing. I'm gonna say a couple things.
Okay.
But you want to make sure that your income is protected, because the income drives everything else. If God forbid, if your income stops today and never starts again, what else is none of the things that we talked about. You're not going to be able to put away for retirement. You're not going to be able to travel in retirement or vacation while you're still working. You're not going to be able to do any of those things without money coming in. So you want to make sure you protect your income. If you have a family, it's an onus to make sure that you have the right life insurance to put in place, so that way if anything happens to you, your family's not burdened financially with it. So that's important. And then also, you want to make sure you're growing your money, because as we started off this discussion with, if you're not growing your money, you're losing money, because inflation will eat it up. So you want to make sure that your money is at least growing at the pace of inflation. You have good growth in your accounts. You have your life insurance in place. You have your income protected. That's 101. That's the if you cover those things, then you have a good foundation of base.
Okay, well, thank you for that excellent presentation. So I know a lot of the questions I asked or other folks asked also is like a one-on-one type of discussion, and to expand on it, it's a little crazy. But how can people get in touch with you if they need to?
Yes, so I'm gonna give you my cell phone number. The best number to reach me is my cell phone because, like most folks, I've been working mainly from home versus the office. So my cell phone number is 703-953-6091. The best thing we could do is call, say, hey, have some questions, and we'll actually set up a time to actually have a meeting and go over everything.
Your number was
And
so fast.
okay. So I'm going to give you both my cell phone and my email address. So my cell phone is 703-953-6091. 703-953-6091. And my email address is first initial J, last name Hilton, Hylton, at B as in blue, M as in mountain, F as in financial, G as in group, F as in financial, S as in service.com. So that's J Hilton at bmfgfs.com. You can reach me by phone, or you can reach me by email. And the best thing to do is, set up a time. It could be 30 minutes, an hour, where we could have at least a preliminary conversation, and then we could go from there.
Okay. Well, thank you again, Mr. Hilton, for coming back onto our program. I'm sure that our members gain a lot from the discussion, and the tips that you provided would hopefully help improve their financial life. Dr. Eddie, I'm not sure if you're coming back or not, so we can say goodbye to Mr. Hilton.
I hope I got the number and the email address right. It's
Yes,
Yes.
I see it scrolling towards the bottom, and it is
Okay.
correct. Yeah.
Okay. Thank you.
And we covered a lot of information tonight, so
Yeah.
hopefully it wasn't too much.
I wish we would have much time to talk about inflation.
I know, because I had a question about Bitcoin. I don't understand what it means or how
And then
we yield.
he's coming back again.
Yeah,
so,
you gotta have me for a third time.
He's coming back again. So yeah.
Okay, we'll definitely do. Thank you again. And yeah, we'll definitely have you back for a third time.
Okay. Well,
Okay.
thank you for
Thank
having
you
me.
very much.
I appreciate the opportunity, and hopefully this information was helpful.
Yeah, it was. Thank you. Thank you. Have a wonderful evening.
You too as well.
Okay, thank you. Bye-bye. Okay. Well, that was good. That was a lot of information.
Yeah, a lot of information. In fact, I can't process all now. I think I have to.
we have to go back and listen to it again. So,
Yeah.
So if you haven't watched the first one, go back and watch it. For those of you watching the program, that was on March 30th, as we discussed. And so we thank Mr. Hilton again for coming on, and we hope he will join us the next time. So I just wanted to say, before we say goodbye, I just wanted to say thank you again to all of you who donated and continue to donate towards Janelle Minson's surgery. Janelle is a little girl that has a hole in her heart and in need of surgery. And there are plans being made as we speak for her to have a procedure done in the coming days, or even in the coming weeks, or even coming days. We'll have additional information, hopefully by next week, as to when her surgery will be scheduled. So thank you again for all of you who donated for that cause. Dr. Eddie and I will be back next Tuesday with our special guest, Dr. Kayla Miller, who's a GYN oncologist, to discuss ovarian cancer. And please make sure, if you're watching, that you find people, at least 5 people, that you're going to invite to that program. Ovarian cancer is a silent killer, and we need to learn more about it to help prevent it. And as you know, if you do go to a specialist, you do have to pay a consultation fee. She's actually coming here and sharing her wisdom and her expertise for free, and speak of prevention and screening. So it would be very good if you're able to attend that program. And as always, if you have any questions or suggestions for us for our program, you can certainly send it to emcuandyourhealth@gmail.com. Again, that's emcuandyourhealth@gmail.com. We are still in a pandemic. Auntie Jane has asked me to remind folks that we are still in a pandemic. So make sure that you stay safe, wear your mask, wash your hands, social distance. If you have not received your vaccines already, please consider getting the vaccines or talk to your healthcare provider regarding your decision. So again, thank you for watching our program, and we look forward to you joining us next Tuesday. And those who are church members, there's a church program at 9 p.m. Thank you and have a wonderful evening. Bye-bye.